Every generation believes it has found the future. In the 19th century, the future had a sound, iron wheels striking steel rails, a rhythm that promised speed, profit, and progress. You could hear it coming before you could see it. Towns that had been dots on a map became junctions, then cities. Farms that once served only nearby markets suddenly had access to ports and distant buyers. Newspapers wrote about a new age, an age where distance was defeated, where time itself could be conquered. And for a while, it worked. Not in theory, in reality. The rails spread like veins across continents. Timber, coal, grain, and people moved in volumes that earlier centuries could barely imagine. The railroad was not just a machine, it was a prophecy. If you built the track, prosperity would follow it like a shadow. But history is cruel to prophecies because it has a habit of testing them with one simple question. If the wealth is real, why does it vanish the moment people ask for their money back? That is the secret behind the banking panics of the 19th century. They were not random storms. They were not simply bad luck. They were the moment the dream collided with the structure built to finance it. Railroad dreams, real losses. The railroad did something no earlier invention had done at this scale. It promised a transformation so large that it attracted money before the transformation had even happened. It turned the future into something you could sell in the present. A route sketched on paper could be worth more than a finished road. A surveyor's stake driven into soil could generate a torrent of investment because people were not buying timber and steel. They were buying the idea of what timber and steel would become. And where the money flows, the banking system follows. Banks in the 19th century did not behave like simple vaults. They did not keep deposits idle and safe, waiting for the owner to return. They operated as engines. They took short-term funds, money people expected to withdraw on demand, and they turned it into long-term bets. A railroad loan that would take years to repay. A railroad bond that would mature far in the future. Shares in a company that might not generate consistent revenue for a decade. That mismatch is the heartbeat of every panic. Short-term promises, long-term assets. It can function smoothly for years, but only under one condition: confidence. Confidence that deposits will not be demanded all at once. Confidence that the securities held will retain buyers. Confidence that tomorrow will resemble today. The trouble is that railroads were expensive beyond what earlier businesses had required. A small manufacturer could expand gradually, reinvesting profits. A railroad could not. It demanded enormous capital up front. Land, grading, bridges, locomotives, stations, maintenance, labor. The profits, if they came later. In the meantime, the bills arrived immediately. So railroads did what modern systems still do when they require fuel before they generate heat. They borrowed. They issued debt. They refinanced old debt with new debt. They expanded not only on the basis of current earnings, but on the expectation of future traffic. And as soon as investors realized that railroad securities could be traded quickly, the psychology changed. The question shifted from, will this line carry enough freight in 10 years? To, can I sell this claim to someone else next month? That is how progress becomes speculation. Not because people are evil, but because systems reward speed. The ability to buy today and sell tomorrow is intoxicating. It makes the future feel liquid, as if tomorrow's prosperity has already been converted into cash. Banks became part of this machinery. They earned fees underwriting bonds. They lent against shares. They held railroad paper as assets. They acted as intermediaries between the dreams of entrepreneurs and the savings of ordinary depositors. A farmer depositing earnings in a local bank might believe that money was resting quietly. In reality, that deposit could be financing track construction hundreds of miles away, tied to the fortunes of distant markets, weather patterns, political decisions, and foreign investors. And railroads had another feature that made the system even more fragile. They were network businesses. A single line's value depended on connections to other lines. A railroad from a town to nowhere did not create wealth. A railroad from a town into a broader network could transform that town into a gateway. So every project relied on other projects. Every company's promise relied on other companies finishing their routes. It was a chain of dependency disguised as a map of progress. When the network expands, it feels like inevitability. When it stalls, it becomes a trap. Because the financial structure around railroads was not built to pause, it was built to roll forward. Debt had to be serviced. Interest payments were constant. Construction contracts demanded cash. Workers demanded wages. The refinancing cycle demanded cooperation from creditors and a willing market for new bonds. If the market refused, even briefly, the rails did not merely stop growing. They began to suffocate under their own weight. This is why banking panics were not primarily about the railroad tracks. The tracks were real. The locomotives were real. The trains ran. The problem was the paper layer built on top of reality. Claims on claims. Promises backed by promises. Instruments whose value depended less on current profit and more on continued belief that someone else would keep buying. A panic begins when that belief cracks. Not when money disappears, but when people remember that money in a banking system is not a pile of coins waiting in a box. It is a structure of obligations. A deposit is a promise. A banknote is a promise. A bond is a promise. A share is a promise. Most of finance is a web of future expectations packaged as present value. And when people grow uncertain, they do something that appears irrational from the outside, but is perfectly rational from inside the system. They demand liquidity. They want cash. They want certainty. They want the thing that does not depend on someone else's promise. That is why panic spreads so fast. They are not caused by mass hysteria. They are caused by a sudden alignment of rational behavior. Each individual tries to protect themselves, and the collective effect reveals the fragility of the structure. If a bank has made long-term loans, it cannot instantly convert them into cash without taking losses. It may have to sell securities into a falling market. It may have to call in loans. It may have to suspend payments. The moment it hesitates, the fear deepens. The moment it suspends, the panic becomes real. What people feared now has proof. The 19th century experienced multiple waves of this, and railroads played a central role because they absorbed capital on a scale that strained the entire financial system. Consider the Panic of 1837. Long before the greatest railroad booms, the United States was already experiencing a cycle of credit expansion and contraction fueled by speculative investment, land, and the fragile banking environment of the era. But as railroads emerged and expanded in subsequent decades, they became one of the most powerful magnets for credit. They intensified the system's tendency toward leverage because they offered a story that made leverage feel safe, the story of national development. By the 1850s, railroad construction accelerated. Capital poured into lines stretching westward, connecting inland production to coastal trade. Banks and investors treated railroad bonds as respectable instruments, often believing that the nation's growth itself guaranteed their value. The Panic of 1857 exposed how quickly that confidence could collapse when the economy hit stress. Declining commodity prices and tightening credit weakened the ability of firms and railroads to meet obligations. Panic spread. Bank runs followed. Railroads that had been symbols of unstoppable progress suddenly became symbols of overextension. But the Panic of 1873 is where the railroad dream and the banking system collided with particular force. By the early 1870s, railroads were not merely projects. They were an entire speculative universe. In the United States, track mileage expanded rapidly. Railroad companies competed to claim routes, land grants, and strategic junctions. Europe, especially Britain and Germany, sent capital across the Atlantic, eager to finance what appeared to be the infrastructure of an expanding empire. The logic seemed unbreakable. America was growing, its population was rising, its land was vast, its resources were abundant. The railroad would connect it all and unlock endless wealth. So why would railroad bonds ever fail? Because logic is not the same thing as timing. Railroads might eventually be profitable, but their financing required continuous access to cheap credit. When that access tightened, even temporarily, the entire structure began to wobble. Interest rates rose, credit conditions hardened, investors became more cautious, the market for new bonds became less enthusiastic, and suddenly, companies that had relied on rolling over debt found themselves facing a wall. Then, a major shock hit. A prominent financial house deeply tied to railroad financing collapsed. J. Cook & Company, a key underwriter involved in funding large railroad projects, failed. That failure was not merely the fall of one firm. It was a signal to the market that the railroad paper supporting much of the system might not be as safe as assumed. Once that signal appears, markets do what they always do. They retreat. Banks pull back. Credit contracts, construction stops, firms fail, railroads default, confidence drains out of the system. The panic spread. Stock markets fell. Banks faced runs. Businesses unrelated to railroads were dragged down because they relied on the same credit networks. Factories closed. Workers were laid off. The economy entered a long period of depression and stagnation in many areas, known as the Long Depression. And here's the hard truth that repeats in every era. In a leveraged system, the collapse of refinancing is the collapse of survival. When easy credit is available, debt feels light. When credit tightens, debt becomes gravity. The human cost of this is often hidden behind the word panic. It sounds like an emotional event, a moment when people got scared. But for ordinary people, a banking panic was not a feeling. It was a sequence of losses. Depositors lost access to their savings when banks suspended payments. A bank might not technically declare bankruptcy, but it might stop redeeming notes or honoring withdrawals. For a family, this meant money they depended on for food, rent, and survival was suddenly trapped behind a counter. Businesses that relied on bank credit to purchase inventory or pay workers suddenly found themselves cut off. Workers lost jobs, wages fell, prices could shift unpredictably. Some people lost everything, not because they made reckless bets, but because they trusted institutions that were built on fragile assumptions. And then there's the other side of every panic, the opportunity. Crises are not only destruction, they are transfers. When credit collapses, those who need cash are forced to sell. Those who have cash, or access to credit when others do not, can buy assets at distressed prices. Property, shares, bonds, even entire businesses can be acquired for fractions of their previous valuations. The wealthy and connected often emerge from panics with more than they had before, because panic turns desperation into discounts. This is not a conspiracy, it is a pattern. It happened in the 19th century just as it happens now. Banking panics acted like economic filters. They punished those dependent on short-term liquidity and rewarded those positioned to wait. That is why the railroads, despite being engines of development, became engines of inequality during these cycles. Many railroads survived or were reorganized. The tracks did not disappear. The infrastructure remained. What changed was ownership. What changed was who controlled the assets after the forced sale. In this way, the dream itself could be true, while the financial experience of the dream was catastrophic for many. Progress can be real and still ruin people, because progress does not eliminate the laws of finance. It often intensifies them. The 19th century had recurring panics partly because the banking system itself was fragmented and unstable in many countries, especially the United States. Banking regulations varied by state. Banks issued their own notes. Reserves were often thin. Information traveled slowly. Rumors could outrun facts. A failure in one region could quickly undermine confidence elsewhere. Railroads, by linking regions economically, also linked them financially. They connected markets and they connected vulnerabilities. By the 1890s, the railroad story returned with brutal familiarity. The Panic of 1893 became another major crisis in the United States, tied again to railroad overbuilding and shaky financing. By that point, many lines had been constructed in excess of immediate demand. Competition reduced profits. Debt burdens remained. Economic stress, including concerns about gold reserves and monetary policy, further weakened confidence. Railroads began to fail. Banks faced pressure. The panic spread. Another severe depression followed. Different decade, same machine. The machine is always the same. A sector captures belief. That belief attracts credit. Credit multiplies expansion. Expansion reinforces belief. Then something changes. Rates rise. Profits disappoint. Foreign capital withdraws. A large institution fails. A political decision shifts expectations. The belief cracks. Liquidity becomes precious. Everyone reaches for it at once. The structure, built on rolling promises, cannot satisfy simultaneous demands. Panic arrives like a verdict. And the lesson is not that railroads were a mistake. The railroads were among the most transformative developments in modern economic history. They reshaped nations. They made trade, migration, and industry possible at new scales. They were not a fraud. They were not imaginary. The fraud, if it can be called that, was the belief that paper claims on a future transformation were the same thing as secure wealth. A railroad bond is a claim on future revenue. A bank deposit is a claim on a bank's ability to pay. A banknote is a claim on redemption. When the system is stable, those claims behave like money. When the system is stressed, they reveal what they really are: contingent promises. In stable times, the distinction between money and promises is blurred. In panic, the distinction becomes everything. This is why the 19th century panics feel so modern. Technology changes, the story changes, but the financial structure repeats because it is rooted in human behavior and institutional design. The 19th century had railroads. The early 20th century had industrial consolidation and speculative trusts. The late 20th century had international capital flows and leveraged finance. The early 21st century had housing priced as certainty and derivatives priced as safety. Different objects, same psychology. A society confuses expansion with solvency, and it builds prosperity on refinancing. Refinancing works only as long as people remain willing to roll the promises forward. As long as confidence holds, the system breathes. When confidence breaks, the system doesn't simply slow down, it changes phase. It becomes a scramble for exits. The 19th century banking panics were not just episodes of fear, they were structural revelations. They exposed that the financial world built to fund the railroad future was fragile, not because the future was impossible, but because the path to the future was financed with instruments that could be demanded instantly, while the assets they funded could not be liquidated without destruction. It was a bridge built out of matchsticks, called safe as long as no one jumped. And when people jumped, it wasn't irrational. It was survival. So when thinking about railroad dreams and banking panics, remember what made the losses so brutal. It wasn't that progress failed. It was that the financing model demanded constant belief, constant refinancing, constant upward motion. It demanded a world that never paused, never tightened, never doubted. But the real world pauses. It tightens. I doubt it. That's why the banking panics of the 19th century matter. They show that technological triumph does not protect people from financial design. The rails can be real. The transformation can be real. And still, the paper system around it can collapse the moment trust is tested. Because finance is not made of steel, it's made of confidence. And when confidence breaks, the dream doesn't just stop, it reverses violently. The future that was sold becomes a bill that must be paid. The promises that felt like wealth become proof of vulnerability. The line between creditor and debtor dissolves into chaos because everyone discovers they were both at once. Every panic carries the same message, written in different ink. Progress builds the world, but finance decides who gets to keep it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.